Oftentimes when people mention the stock market, they're usually thinking about the S&P 500, and this is just an index that represents 500 of the largest companies in the United States. But the stock market is so much more than that. There are tens of thousands of stocks worldwide, and many of them are small businesses that you and I have probably never even heard of. However, these companies can sometimes offer the best returns. So stick with me as we explore this a little bit further. When discussing big companies and small companies, you'll often hear the terms large cap and small cap. These refer to something called market capitalization or simply market cap. This is the idea of the price per share multiplied by the number of shares outstanding. So for a simple example here, if a stock trades for $25 per share and there are 100 shares outstanding, the market cap would be $2,500. To give you an idea of the size of some of these companies that we're talking about, Apple, make computers, iPhones, whatever. Apple recently had a market cap of over $3.3 trillion. That's trillion with a T. And Microsoft and Nvidia are other companies that are hovering around that 3 trillion mark as well. On the other hand, small cap stocks typically have market caps below 3 billion. Though this can vary depending on the index provider and who you talk to, there's no set definition of what defines a small cap stock. Over the past decade or so, the stock market has been driven mainly by large growth companies. And when I say growth, I'm not talking about size anymore, but rather just how these companies are valued. Growth stocks tend to be expensive relative to things like their profits, book value, or sales. The opposite of these stocks are value stocks, which are cheaper relative to their fundamentals of the same metrics, profits, book value, sales, any number of different things. So why does this matter? Recently, large growth companies have dramatically outperformed their smaller value counterparts. This trend has led many new investors to think that the S&P 500 and other large growth companies, particularly in tech stocks, this is the only place to invest. Why wouldn't you just keep buying what's been working? Well, if you look beyond just the most recent periods of time and you zoom out over many decades and across countries and time periods, value stocks have actually tended to outperform growth stocks, and small caps have tended to outperform large caps, especially once you exclude non-profitable small caps, because there are tons of companies that just make no money even though they're publicly traded. There are sometimes large stretches where these trends are reversed, but the evidence is pretty compelling for including both small companies and value companies in your portfolio. Now, don't get me wrong though, large US growth stocks definitely have their place in a diversified portfolio too. But this past month has shown why it's essential to be more diversified and not always lean into the most expensive parts of the market. Here in July of 2024, we've seen the relative performance of small cap value stocks take off compared to large cap growth. In fact, the difference between the two categories has been nearly 14% just in the last month. And what makes this gap even crazier is that this shift happened almost immediately. And so if you didn't have any exposure to small cap value stocks, you might have missed it already. But could the trend continue? Who knows? Could large cap growth stocks outperform again? It's anybody's guess. And anyone who claims to know the future, especially with investing, is likely trying to sell you something. So don't waste your time trying to predict the future. Instead, dig into your diversification a little bit more, and next time you'll be at the party before the party starts. So I don't believe in an all or nothing approach to portfolio construction. You shouldn't be only in small cap value stocks or only in large cap growth stocks. Diversification just goes so much deeper than country allocation or stocks and bonds. Diversification can include smaller companies and those with different valuations to take advantage of opportunities when they arise. As the famous basketball coach John Wooden said, when opportunity comes, it's too late to prepare. Now, sometimes you need patience to stick with a diversified portfolio, but done well, it can help capture the premiums from different parts of the stock market. If you're new to my channel, hi, I'm Evan. I'm a certified financial planner professional. I discuss financial planning, investing, and retirement planning topics for Canadians. And if that sounds interesting to you, subscribe to see more content. Thanks so much for watching, and we'll see you in another video.